Welcome back, everybody, to another session in our series, Perspective, Not Predictions. This educational series is designed to give you practical insights and hopefully some takeaways to be a better long-term investor. So today, we're going to dig into back-to-back negative market years. As we're moving towards 18 months of a bear market, the statements that we've been opening, the headlines that we've been hearing, it starts to weigh on us as a long-term investor. Don't worry, that's a natural feeling you're going to run into. We're emotional as human beings. We're not hardwired to make short-term decisions that affect our long-term. So it's just a grind of bank failures and recession talk, all kinds of these dire predictions that make it difficult to stick to your guns as a long-term investor. So we want to unpack that a little bit, look at the numbers, but people are certainly feeling that with the news out there and the economy just unsure on what it's going to look like, could 23 be a similar or even worse year than 2022? So let's dig into it. Certainly we don't have a crystal ball, and of course past performance doesn't guarantee future results, but when we look at the numbers, it's very interesting. Over the past 100 years, there's only been 4 times that the stock market has had back-to-back or consecutive negative years. Some of these we've had 3 in a row, but you have to go back to the Great Depression for the first time it happened, late 20s, early 30s. Then fast forward to just before World War II, 39 to 41. Didn't happen again until 73, 74 with the oil embargo. Another long clip of time passed, and we had the tech bubble and 9/11. Even in the financial crisis of 08, 09, we only had 1 calendar negative year. It felt a whole lot worse in the moment, but we didn't even have back-to-back years then. So what does that mean? Let's take another perspective. What if we take a little bit more of an optimistic view? Since 1950, 72 years, it's only happened twice. And in those periods of time, 3 out of 4 years, you made money in the stock market. So the case for being a long-term investor is certainly there. And by the way, if you stayed invested through all of that, rose above the noise of the media or the predictions, you had an annualized return of just over 11% in the S&P 500 with reinvested dividends. So again, long-term investing in hindsight is easy. In the moment, it can be difficult. So what does that mean for us today? Just wanted to be brief in talking through this, but we're not in the business of making predictions. This is perspective, not prediction. So the perspective and the takeaway should be, look at your long-term financial plan. Odds are it's on track if you had a properly diversified portfolio. As painful as owning that portfolio may have been over the last 18 months, your plan is more than likely on track. If you're unsure, does your investment portfolio align with your long-term plan? We'd love the chance to talk and take a look at that. It's a lot of what we do and have these discussions to separate media and noise and portfolio declines with the long-term trend that you might be on. So our hope really is just filter out the noise, avoid the media and the predictions and some of these dire things that are out there, and control what you can. Focus on what matters, and you tend to be a long-term investor if you can do that. Thanks for your time today. Look forward to talking with you on the next session. Have a great day.